Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, April the 2nd, 2025. Of course, as everyone knows, this is the big day where Trump will be announcing at 4 p.m. Eastern Time the tariff policy. We do have a Lutnick, the sort of the trade, the Secretary of Commerce, speaking, I believe, at 8:30 this morning. Maybe there'll be in an interview, maybe there'll be some kind of information to give a little bit more detail, but it probably could just muddy the waters a little bit. We also had yesterday from Treasury Secretary Bessent just a little comment saying that the tariffs of which we're getting today would probably be sort of some kind of maximum cap, and leading us to sort of understand that maybe it was like that would be like the opening negotiating position. But as it stands, it looks as though there are kind of three main sort of broad possibilities which Trump might be working on, or the administration. And one of them is like a 20% sort of universal tariff across all products in all countries. That would probably be considered fairly negative for the market. So a 20%, 25% universal tariff, all countries, all products, very negative for global growth and trade. Secondly, maybe a bit more nuanced, kind of a tiered system, maybe with three different rates, sort of three different rates for different sort of countries and products, and then possibly a sort of a country by country. And yesterday, the Trade Department of the US sort of released, I actually had a quick look at it, like a 300-page PDF, literally looking at every single country and the way that they sort of, interact with the US in terms of tariffs and whatnot. And so there could be a country by country thing. So maybe Japan gets 10%, European Union gets 13%, Canada gets 17%, who knows? But I think the point here is that there will be a lot of volatility. But just stepping back a little bit, it seems to me that probably what will happen, yes, there's going to be some volatility on the announcement. Could be a little positive, could be a little negative. But then we have to start thinking about the possibility of negotiations and sort of carve-outs and all kinds of complexities. And so I think really the way the market has been looking at this, and the way maybe just to simplify things, is to look at it from a growth kind of perspective. The market's been quite sort of focused also on inflation. But it looks as though inflation in the US is a little sticky, but not out of control. And inflation in the European Union, which we got yesterday, is coming down to a reasonable level. It's still in the 3 handle for the services, but we're getting down towards almost 2% in the manufacturing. And so as Lagarde was saying this morning in a speech, Christine Lagarde of the ECB, inflation's getting down to a sort of a reasonable point, which is close to target. So I think all that to say, the idea is really to say, well, okay, how will this sort of tariff policy affect the US in terms of growth, and also how will it affect the world in terms of growth and global trade? So therefore, if that's the situation, I think it behooves us to sort of continue looking at sort of data and just to say, well, okay, what's going on? And the other issue as well, which is very important, is that there had been in the last few years, this idea that the soft data and the survey data would necessarily lead to or be some kind of precursor of what actually happened in the real economy with the hard data. But what we saw in 2022, 23, and even 2024 is that the survey data and the hard data did not necessarily correlate that well. And that was just because I think the market was completely underestimating the effects of the incredible fiscal stimulus in 2022, 23, just to sort of keep the US economy afloat. And so now what's happening is that we're starting to see, again, the soft data or the survey data is seemingly kind of weakened. But I think the market is a little more skeptical sort of to immediately translate that into what will necessarily and definitively sort of happen with the hard data. So I think at this point, keep one eye on the soft data and the survey. But I think really the way to trade this is actually to say, well, okay, what is actually happening in the real world, in the real economy? So we're going to get a bit more information today. Well, actually, let's just look and see what happened yesterday, because really what I'm trying to focus on now is just to really understand just where the data is leading us and what's actually going on. So I've got just what we had yesterday. We had JOLTS and ISM, and useful way of doing that, just look at the daily shot. They have a pretty good summary of all the data. And if we actually look at it, we have to say that if we look at the JOLTS data, which is a kind of sort of hard data, so that definitely has some validity. The job openings, it does seem to be pretty clear that the number of job openings is trending trending downwards. It's not a massive and sudden trend downwards, but it's definitely sort of going down. Having said that, it did go up recently. So, definitely that looks to be sort of softening. And then if you look actually at the changes by sector, professional business services up pretty good. Construction is still doing okay. And, a lot of people say, oh my God, the whole sort of construction industry is going to collapse and everything, but that's actually doing quite well. What didn't do so well is finance and insurance, which is in retail trade, wholesale trade, accommodation, food services. So I don't necessarily see a pattern there. But what is interesting is that the layoff level is starting to tick up. So people are being sort of fired a little bit more. So that is definitely going up. I won't look at the beverage curve, but then if you look at Indeed, which is a huge job posting site, that does seem to be sort of definitely sort of going down. So that seems to be weakening. So I think that the takeaway here from the ISM, from the JOLTS numbers is that people there are being fired a little bit more. There are less job openings. So overall, sort of gun to my head, the 1 second summary would be the job market seems to be sort of loosening a little bit, just slowly. So just slowly and steadily, not dramatically, but slowly and steadily. And we know the Fed is looking at that. Okay, then if you look at the survey, the ISM manufacturing, that actually came in a little bit weak as well. And so you see that the headline number here, it came in below the 50% kind of expansion or contraction. So that does seem to be sort of heading down a little bit. But then again, you can see this number is quite volatile. And going back to last year, it was much lower, then it went up, now it's come down. But it does seem to be going down. And then what's sort of interesting and probably a little bit more disturbing is to look at the subcomponents. And we can see here that the new orders, which was -1. So new orders, and again, keep in mind what this is a purchasing managers, what they anticipate will be happening next month. So it is sort of a human input. It's not a purely numerical or database thing in the sense that this is like surveys of what humans, important people at companies believe will happen. So it's not nonsense, but it is sort of a human, it is subject to human fallibility. But what we are seeing is that the estimates of new orders is definitely sort of negative. You see the brown here sort of pretty low. Production down a little bit, unemployment down as well. So quite a lot of negativity there. You see new orders and production and employment all anticipated to be on the negative side, just looking at the bar chart here. And then if you look on the so-called positive values, the problem here is that the inventories are up 0.7. So you have a sort of an unpleasant situation where the inventory levels are rising, which indicates that there's too much product which will need to be sold, and new orders are going down. So that's not a very good mix. And I think here they actually have a chart which shows, yes, you see new orders coming down, you see employment coming down, and then look at the inventory levels. And then if you look, of course, you can do like a little chart and show the spread between new orders and inventories is looking a bit negative because that's normally a sort of a precursor of negativity. Now, having said that, could the inventories be high because a lot of people maybe were sort of maybe getting in supplies, trying to front run today's tariff announcement. So essentially companies, buying a lot of stuff which they need to manufacture goods and therefore having a lot of inventories, or maybe wholesalers, retailers stocking up on everything they need to produce or to sell. And therefore the inventories are high. So it's not necessarily obvious to me that this inflated inventory number should be understood in the classical or the traditional sense of a sort of a slowdown. It could just simply be a lot of front running. And obviously in something like the precious metals case, we've seen like the inventories going up at the COMEX exchange in New York, trying to front run the tariffs. That's a whole other thing. And then, but what we are seeing is the prices paid is going up. So overall, it seems to me that maybe employment is slowly sort of weakening. Maybe the economy is slowly going down, but inflation does seem to be staying a little bit sticky. Not at crazy levels, but we're talking higher than 2.5, maybe even up to 3%. That kind of range. Now, what does that mean? That means that the Fed does not have as much flexibility to ease should the economy weaken, should the employment situation weaken. The Fed's hands will be tied a little bit. It's not like in the past 10 years where the Fed could instantly slash rates at the first sign of weakness. Now with the sticky inflation, they might want to be a little bit more cautious. And indeed, if the economy still seems to be doing relatively well, the labor market seems to be doing relatively well, and the tariffs today are perceived not to be too bad or less bad than feared, that could mean that the Fed is going to stay and, not cut rates for, at least several months. But what is interesting here, just again, just want to look at something here. I just had something, I think it was on car sales. Um, I may be mistaken. Uh, yeah, kind of interesting here. And this is what I'm talking about in terms of inventories and front running. So just look at here, it's like vehicle sales went up in March as consumers tried to get ahead of the auto tariff. So what we saw here is that this was some of the sharpest sort of sales in cars in the US for quite a long time. And again, a lot of people are saying that was, it was simply a function of trying to front run the tariffs. So does this mean that in the future, the car sales could go down dramatically, just as dramatically on the other side, and kind of reflexive kind of sort of a counter reaction to that? Well, interesting to see. So all that to say, that was the data. And then today we get a little bit more data. We get the ADP number. So the ADP is the huge American automatic data processing company, which does all the payrolls, well, not all of them, but most of the payrolls for the private sector. Again, a lot of people say, it's not perfectly correlated with the non-farm payrolls, which we get on Friday. But the point is, the market will be looking at this. We're estimated to have 120,000, which is, more than last time, which was 77,000. Still, not the strongest number, but solid. If we get anything around, 125, 130, 115, that's still indicating a relatively solid labor market. So let's keep an eye on that at 8:15. Will the market react? Probably. But again, the market is probably just going to be in some kind of holding pattern today before we get, potentially a lot of volatility at 4 p.m. as all the information starts to roll out from our friend Donald. Now, just talking about volatility, kind of interesting to see what the market is pricing. So what I've got here, I've just got for the S&P 500 futures, so the ES contract for the June contract, of course. If you have a look here, you can see here the ES, just in terms of the 52-day implied volatility percentile, we're in the 98%. So very, very high implied vol. On the other plan, the ranking is 41 over the last 52 days, 52 weeks. So not, at the highest possible levels, but still at, let's call it a relatively elevated level. And if we actually just put here and see what the straddle is, so what I'm going to do here, I'm just going to sort of throw on the straddle here. So let's say we just choose, and again, this is expiring tomorrow. I haven't done the 0 DTE because, as I say, Trump is talking at 4 o'clock, and of course the futures are open at 4 o'clock. Cash market closes, futures close at 5, as we all know. But the point is here, so that's why I've done sort of 1 day expiry, so expiring tomorrow, Wednesday, April the 3rd. So if we go at, let's say, a 50 a delta here, so long that one, you can see here. So we're buying a put and a call sort of at the money, and you see basically that's going to cost you 100 points, so 400 ticks. So that basically is what the market is pricing in, and you see the implied vol at the money is about 36.8, so pretty high. And again, dividing that by 2, as we is the sort of the maths, that's assuming something like about just over a 2% move is sort of what the market is being priced for, and you see that's about 100 points. So if you look at what 100 points looks like on the chart, let's just bring up the SPX here, which is here. So again, just looking at the cash market, we could see, again, I've just got the average true range here. You can see the average true range here. That's 100% down to here, and then 100% up to their move. Again, this is the SPX, so it hasn't opened today as I'm speaking. So you're looking at this kind of price movement, average true range down to about 55.20, and on the top side, about 57.06. But what's kind of interesting, if you look at what 2% looks like, again, so if you look at 2%, you're looking, something around about there, which is about 57.50. But that's pretty interesting level there, about 2.38%. I would say if we get sort of some positivity. Now, what's positivity going to look like? I think if we consider that growth is really the most important thing, which the market's worried about, like how will these tariffs affect growth? I mean, what would good news, quote unquote, look like? I think there's maybe like 3 or 4 things we should look at. I think anything which looks as though it's going to be avoiding retaliation. So if the idea is that the market gets a sense that the US's trading partners will, more or less avoid aggressive and immediate retaliation, that would be a positive, good for equities. I think the other thing as well, we need to focus on reciprocity, this whole idea of if it's simply reciprocal and not punitive. So what I mean by that is that does Trump say, oh, we're just going to tariff everyone because we hate everyone and we're being treated badly, or whether it's a much more nuanced, specific, technical. Thailand has a tariff on US, average tariff on US goods of 7.8%. Therefore, in the US, we will put 7.8% on Thai goods. That kind of thing. I think the market will find that a little easier to deal with rather than sort of blanket, punitive kind of tariffs. Other thing I think is the market wants to be looking out for is any openness to negotiate. So let's say, for example, Trump announces all this stuff, but says, of course, that he's being kind and he's going to see how people react. And if we get a sense that countries want to sort of negotiate, and Trump is open to negotiation, I think the market will find that positive. And the fourth thing, which I think would be a positive for the market in terms of sentiment, would be Trump has talked about sales tax as being a kind of a tariff on US goods. And as we know, most developed countries, they have one kind of VAT, value added tax or sales tax on all kinds of products. And it's not realistic to think that the whole developed world's economies will suddenly scrap their sales tax. The US doesn't have it. I mean, Canada has it, Australia has it. Europe has it, the UK has it. So the point is that Trump has said, no, these sales tax and VAT is a form of tariff. And a lot of people saying, well, not really. It's a different kind of situation. So I think the point is that if Trump today does not treat sales tax, VAT as a tariff, I think that would be a positive. So they're the four things I'm looking out for. Now, I think if we get some sense of that, as I say, sort of avoiding retaliation, kind of focus on very specific reciprocal kind of sort of implementation and openness to negotiate and avoiding VAT or sales tax as a tariff sort of level. I think we could get a pretty nice rally in the stocks here. And again, this level here, up to 2.38%. Is maybe going to be possible. And I think that level here up to about 57.67, something like that, 57.65 would be a pretty good first stop. Might stop there, but even if the market really wants to keep on going, I think 58.65 could be like the uppermost at the moment. Because even if we get a short-term bump, the medium-term prognosis is tariffs are not great. Now, I don't know how inflation they're going to be or the exact details of country by country retaliation, et cetera, et cetera. You're starting to enter into a very complex series of factors here. But medium term, this potentially could be at least at the margin a little bit inflationary, could be a slowdown in US growth and potentially even global trade and global growth. And ultimately, that's not going to be good for the US stock market. So I think that's your first target on the upside, is around about 57.65, and then potentially, if the market really likes it, up to 58.65. But I think at that point there, that could be interesting shorting opportunity. On the other hand, of course, what does it look like for the bonds? I think if we get any kind of positivity, I think that means that the Fed might be less willing to cut. As the market might have some animal spirits. And, at a minimum, I think we could see the short end probably selling off. Again, to the downside, you got to say, well, what does, 2% look like? And the 2% is probably at a minimum going to sort of retest down here, maybe 5,500, something like that. Could it go a lot lower? If we actually look, I think also what's a reasonable target is somewhere around here. So if you go back just like a little bit, pretty key levels here, we have a couple of gaps and whatnot. So I think also that would be 4%. That would possibly take over a few days or a week or so. But I think sort of a level down, around about here, 50, 53, 50, 53, 60 down there could be a possibility. And on any negative. So what, again, negative would be the opposite of what I just said. So that would be, sort of across the board, 25% tariffs, not too much nuance or differentiation, a lot of retaliation, no sense of specific reciprocal targets, but just sort of blanket tariffs, Trump being very intransigent and saying, no, that's it. We're not going to negotiate. That's the way it is, et cetera, et cetera. And also maybe number 4 is treating VAT or sales tax as some kind of tariff. So, blanketing or targeting everyone with that. So that's it. So just again, looking at the ES here, just want to sort of put it in perspective, going back to the options market, what 100 points look like. You can see here the ES has come down, and there was a report actually, I'll just see what 100 points looks like. So you're looking at 100 points. You're looking at, yeah, around about here. So he's testing these new lows, or the recent lows of about 55.15. That's about 108 points. Now, on the upside, you're looking 100 points is looking something like that. I think it could probably go a little bit further, to be absolutely honest, on the upside. And what is interesting is that we did just get just put this on a 3-minute chart. You see the ES here futures have been sort of selling off. And specifically, they started selling off around about 6 a.m. this morning. You look at that, so they are selling off. And partly the reasons for that, there was a sort of a news story, just looking here on Bloomberg, which I just brought up and just was looking at, this idea that China, it seems, is restricting companies from investing in the US as tensions rise. So you see, this was released here about just around about just 6 o'clock or so. And without going into the details, we can just look at the summary here. China has restricted local companies from investing in the US, according to people familiar with the matter. People familiar with the matter, that's always a very vague source, but potentially giving Beijing more leverage in trade negotiations. So bottom line, it's at no immediate cost, but I guess this is Beijing's way of signaling to the US is like, hey, you want to sort of start putting tariffs on us? We, of course, can, just sort of slow everything down and stop in investments, in fact, enforce investments. But just keep that in context. If you actually look how much, new investment there was in the US from China, this actually has been slowing down quite a lot. And we're certainly, quite a long way from some of these levels, which have seen, in terms of billions, and not a lot of new investment here. So on the other hand, you have to say how significant this would be. But I guess the message is, and again, it gets back to one of my points, that retaliation. If the market perceives that China will be extremely aggressive in the retaliation, US stock market will not take that well at all. Okay, guys, so I might just leave it there. I mean, again, we could look at some markets, but the reality is that everyone will be just essentially waiting. The big players will be waiting for these tariff announcements. But just as you can see here, the ES selling off. VIX, let's have a look at VIX. VIX, up into the mid-20s, so relatively elevated here. Just keeping in mind, if you look at the MAG 7s, still very weak price action here. The equal weight still also trading, sort of along the lows. This is still weak price action anyway you look. If you look over in Europe here, actually, I'll just get rid of this thing here. If you look at Europe here, also trading along lows. But again, quite an interesting level here for the Euro stocks. If these tariffs are perceived to be sort of more on the lighter side, could we see from these levels a bit of a pop and a bounce? Absolutely, we could definitely see that. Because remember that Europe is still reflating, especially Germany. Apart from that, we're just seeing this morning the front end of the bonds having a little bit of a bid, the 5 up. We also see like the 10 up, and we see the ZB up, the 30-year. So the bond's getting pretty well bid up here. Similar kind of situation in Germany. So a bit of a sort of a safe haven fear kind of reaction here. Again, note that the bonds are being bid, paying less attention because of inflation worries. And as I say, yesterday in Europe, we had pretty encouraging inflation sort of numbers. So less concern about inflation, more focused on sort of the hit to growth narrative. And that's why the global developed market bonds are doing relatively well. Just having a quick look here at oil, just taking a little bit of a pause here at this sort of fib retracement level. I think there are also some moving averages here. If we just throw on some of the MAs, you see just sort of between this 100 and 200-day MA. And again, oil will not like any sense of a slowdown, a global slowdown. Global trade slowing and global economic growth slowing is not good for oil, and especially not for the sentiment. We also had yesterday afternoon API at 4:30. We had a build, which is also not great for the WTI complex. But really the story today is probably going to be about the tariffs. Finally, for the dollar, just looking at the dollar index here, as you guys can see here, just sort of trading pretty choppy sideways action. The dollar is a complex one. There are those who are saying that ultimately a slowdown in the US economy, if indeed that proves to be the case, it's got to be dollar negative. Could there be a short-term pop? Because of, just tariffs considered sort of inflationary, a little bit of a safe haven flow. It's possible. It's going to be very complex. But what we are seeing is that some of the commodity currencies, in general, are being, a little bit sort of under pressure. So, we'll see what happens, and really have to look at some of the details here. Just finally, just having a quick look at gold. Looks like gold had a couple of hours sell-off. Looks to be green again, so possibly heading up. And again, that makes sense if you're worried about inflation, geopolitical tensions, and maybe a more dovish Fed if there's going to be a significant global slowdown. We'll see there. Just finally, silver up a little bit, and copper just bouncing just a tiny bit. Okay, gonna leave it there, guys. Let's see what happens at 4 p.m. from the Rose Garden at the White House, and have a great day. Thank you very much.